Now.
Good morning, everyone. My name is David Jaffe. I'd like to welcome today's session in our New Economy webinar series. And today we've got two returning speakers, my co-director, Laurent and our customer specialist, Darrell Hardidge. And the topic today is customer due diligence, the new standard. And I just want to say, I wish you guys were around a long time ago, because this is a thing close to my heart, because when I'm talking to clients, when they're buying a new business, one of the things that has been lacking is this due diligence on the customers, because everybody looks at it from a legal perspective, a financial perspective, but no one's drawn the line to where you guys have drawn the line. And I'm really thrilled that we can be presenting this topic today. So over to you guys.
Thank you very much, David. Good morning, everyone. My name is Laurent. As David explained, I'm co-founder of Successful Business Advisor, but as well I'm a partner of Sagwiti with Darrell Hardidge, and we're going to go through customer due diligence, the new standard. So, Darrell, would you like to say a few words?
Sure, thanks, Laurent. Yes, good morning. Look, what we're going to cover today is what we call a whole new standard around due diligence. And as David mentioned, it's often left out completely. The three key areas of commercial due diligence, financial due diligence, and legal due diligence are critical in any successful assessment of a company. But one of the key areas that's always been left out is customer due diligence. And it just came about really by opportunity a few years back in our research company, where we had our clients were purchasing other businesses, and of course they had all of their customer data and they knew exactly what made them strong and what have you. And so they got us to do research on their actual customers of the business they were looking to buy. And out of that, we actually found that our content was unique, and it had never been seen before by any account that we spoke to and any company we were looking at with in the stages of due diligence. So it sort of just morphed out of there, really. And the key to it was that is when Laurent got involved with our company, because of his history with working in due diligence at one of the top 4 accounting firms, really made us aware that what we actually had was something very unique, and that it isn't done at all. And I just kind of assumed that this was. I figured that customers would always be a central part of the measurement in assessing the value of a company. At the end of the day, the financials that is done through the financial due diligence is all as a result of customer engagement and customer loyalty primarily. And so without that, I was quite amazed that how could you assess the successful future revenue of a business if you don't have any feedback from customers. So it sort of created from there, and then over the last few years, we've done some major projects with some quite large mergers and acquisitions. And in this case, when we've implemented our process, we've been able to really advance the information, and most importantly, our objective is to always be able to protect the investors, because the investors at the end of the day are the ones that are putting up the money. They're taking all the risk, and they've been sort of stuck with an old model that required them to rely upon the financials of the past to give them an indication of the security of the future. And of course, that doesn't make sense. So this process we've created is actually evolving into a really good methodology of providing great insights for investors and the company that's entering due diligence, the purchaser, to give them a completely new understanding of this business. And what we see happening right now with the whole COVID situation makes this quite unique, because when you're looking at the traditional modeling of assessing customers, and from a financial perspective, they're looking into the past. And right now, what happened in 2019, 2018, for a lot of businesses today, those financials are completely irrelevant to what you're looking at now.
Correct.
And the real challenge now is financial forecasting is incredibly difficult in this COVID situation. And so what we say to our clients and to anybody watching this, if you're looking at due diligence, if you're looking at purchasing a company, the past is almost irrelevant now around financials. You've really got to understand how the customers feel about this business right now, and most importantly, how they feel about the team. Because the team and all the processes in the business, they are the ones that deliver the service to the customers. So you've got to get this double line of information from the customers coming back to the business, and also how the team performing going back out to the market. So that's kind of an overview. Back to you, Laurent.
Thank you very much, Darrell. And I would like to just before to move to the next slide, when give a bit an history on when I met you for the first time, and Darrell was doing a workshop, great on customer experience and the measurement of customer experience. And for those who don't know me, I got a financial background, and I was working for one of the big four, Ernst & Young, and started in audit, and after M&A and a bit of business development at the end, and so few deal and transaction. In a budget, in a financial forecast, there is never a line for retention. And when customer retention, when I heard that for the first time from Darrell, straight away, it bounced on my head, and I said to myself, wow, I saw hundreds and hundreds of financial statements and budget and financial forecasts. I saw plenty of marketing expenses and budget on a lot of marketing expense and a lot of assumptions. But I never saw any line on retention and how I'm going to keep my client base loyal to our company. So that was a really good start. It's from where I thought it was important to mention to start this webinar. So why we are here today, it's a fact that on average, the M&A failure rate is 60%, and it's really the bottom of the average. We really took a very conservative bottom, because there is, depending on the reports from one global firm to another one, it could go up to 70, 80. So let's say that on average, 60% of M&A deal fail. That is not something that it's a lot in the media, but it's a fact. Another fact that has been definitely noted, it's that M&A transactions are often overvalued. And you buy them, the buyer is going to acquire the vendor entity. It could be a merger, or it could be an acquisition on a premium price. Unfortunately, with the time, it appears that the price was overvalued, and it's when happened impairment and write-off of goodwills that have been really overvalued. All of that, the calculation of the goodwill, and it's important to mention, just to put an emphasis on Darrell's comment, it's all the calculation is from the past, and the past financials, the last 3 years, past multiples, and so on. So, having been there and done that, I never saw in my previous career in working for a big firm, really having the knowing of the behavior of the client base right now, on the moment of a deal. So very important, independent market perspective, same thing. It is important to really assess and measure more than assess, measure the market perspective on an independent point of view. And finally, why we are here is to reduce the revenue risk. Because after all the forecast and all the valuation of a deal and a business is made from the revenue and going down. So if you got the revenue wrong at the start, you got a big risk for the rest of the business. So if we move on to one diagram that is very crucial for you to give you an overall picture, and Darrell, I invite you to go through this.
Okay, thanks, Laurent. So basically, when you're looking at what is customer due diligence, the arrow on the left that says everything speaks in it, this is basically the company in question. So the company has all of its processes, its people, you know, it's stock delivery, whatever it may be that the company does, product or service. And the arrow on the right is the customer. So marketing is basically designed to go out to the market and bring the prospective customers into contact with the business. And so in the due diligence, you want to be able to ask the customers, for example, how did they find us, especially new customers in the last 6 to 12 months. If you in this process, you really want to separate the customer base from the long-term loyal customers, because often what happens when a business goes to market, they will put all of those really long-term loyal customers up as the ones they want to present as the strength of the business. But it's very important that you have a clear understanding of how the most recent customers feel about their experience. Because for a lot of businesses, especially in the high-end stuff, usually when you acquire a new customer, it is the result of them leaving someone else. So we're not talking $15, $20 transactions or buying a pizza. We're talking about people, in most of the cases, they've got quite high value transactions. So they're not new to the market. And what that means is that if they're coming to you, it usually means there's some frustration in their current supply. So that's what we're also looking for as well. So marketing is what brings people to connection with the business, and you want to make sure that that marketing is working effectively, because quite often you'll see in the expenses in the financial due diligence a large amount of money spent on marketing, but there isn't an actual calculation for the cost of new customer acquisition. So these are the sort of things that it's very important that you can get the marketing costs and you can look at how many customers did it actually purchase in the last year. So you spend $100,000 on marketing and you get 1,000 clients, it's cost $100 a client. So it's looking at how you can break all this up. And then the sales process, that's what brings the two together. That's what brings the company and the new prospective customer together. And when they sign that contract or whatever the terms of engagement are, in that moment, there's been a major promise made. And especially if somebody's leaving another business and coming to this company that you're looking at, you want to make sure that the sales process has actually set the deal up for success, not to set the deal up for failure, basically. And quite often, you look at this and we measure the performance of sales and account managers. And why that's very important in any project you're looking at is because quite often the marketing and the sales teams are paid bonuses for acquiring customers. And so they will go out and just acquire customers at all kinds of crazy discounting and so on, because that's where they're paid. And what happens after that, they don't really care about. So quite often when we've looked at this, we found the onboarding of new customers in the last 6 to 12 months, there's quite a bit of frustration because what they were promised in the sales process isn't actually happening in delivery. And it's critical that you understand that when you're looking at acquiring a company. So marketing and sales are the two critical ones, and they're often spoken about in the due diligence process, but what they don't have is customer information that actually bring those two together, which is what we do. Then after that, you'll see you've got team. And all those little 10s there is relating to the optimal structure. So if the team is operating at 10 out of 10 and they're a really aligned, highly trained and a great team, then all of the interaction back to that connection point where that number 1 is, that's basically referring to customer engagement. So you want to make sure that in customer due diligence that they're talking about the team. Because if they just talk about product and what we call head drivers, which is things like stock, delivery, pricing, car parking, got the brands I need. They're just talking about the stuff. And that's very easy for another competitor to come in and match that. So in the due diligence, what you're looking for from customer due diligence is how often do they speak about the performance of the team. And if they speak about the team in a very personal way, and they talk about them being helpful and friendly and understanding and trustworthy, being a team that do whatever it takes and they'll go above and beyond to serve you. If these are the kind of things that are coming up in the feedback, then that's giving you a direct insight that it's got a good team, and a good team can only come from good leadership. So right at the very early stages of customer due diligence, we're looking for what's going on in the marketing, what's going on in the sales process and the onboarding of new customers, and how does that all connect to the culture of the business, which is the team. Then you may have subcontractors, for example. So if you've got other suppliers as well, you want to be able to measure exactly how well they're performing too. Because that little green number 1 is engagement. So that's every phone call, it's every delivery, it's every invoice, it's every part of customer experience has got an impact and a measurement. Things like support and help desk, if you've got service or warranty or backup or whatever it may be. Communication. Out of all the data we've done, and my company's done over 500,000 phone calls, and we're all based out of Melbourne. So we do a lot of customer research and have done over 10 years now, for over 10 years. And the number 1 complaint that sits in businesses out of our journey from all of our research is actually communication. So it's really important that in the due diligence process, you have the ability to understand how good is the team and the company communication to its market. Because if that isn't strong, it's vulnerable. So you want to make sure that if you're looking at a business and if there is complaints around communication, that's telling you straight away there's a breakdown in connection between leadership and the team and the customers. And most importantly, if you were looking at this business and a competitor did a strike on the same market and you don't have good communication, you're very, very vulnerable to a competitor coming in and taking your customers. The other thing is things like IT. You want to make sure that it's easy to buy, it's easy to find product, there's good information, etc. And of course, another critical one is delivery. So if I'm buying products and services from you, or products from you, for example, and a common one these days is using outsourced couriers and so on for delivery. So you could get everything right across those touch points. You could have great marketing, terrific sales team, great people, really good support, excellent communication, the online ordering experience and everything else is fantastic, but the courier drops it, breaks it, leaves it at the front door, doesn't sign off on it, does a poor job, and now the overall customer experience is now impacted. And instead of it being that optimal 10 out of 10 or at least a 9 out of 10 experience, it might be a 7 or an 8. And unless you go to the customers, you're not going to understand exactly why this business doesn't have that, what we call unshakable loyalty, where no matter what happens, they're not going to leave you. A competitor can knock on the door with a cheap price and these customers won't leave the company. And quite often what happens is the delivery process for those that outsource, they don't put a measurement on that. So when you're talking about customer due diligence, you want to understand every single touch point of the business, because everything speaks to the market in any task that's done. And so we really want to make sure that that connection and that engagement, how effective is that? And obviously 10 out of 10 is the ultimate score. 9 out of 10 is a great score. 8 out of 10 is customer satisfaction. And a lot of due diligence these days, it talks about customer satisfaction. But the big thing to be aware of if you're looking at a business is satisfaction is just giving people what they want, just giving them what they're paid for. And the loyalty there is quite vulnerable. It's not very strong at all. So it's really important in customer due diligence that you're not looking at financials of what happened. You're looking at all the processes of what's happening and what's that going to do in the future. So that covers that part, Laurent.
Thank you very much, Darrell. One distinction that I would like to make on this for people that are watching is that usually, and more than 90% of the due diligence that could be financial, commercial, and legal everything is looked from the inside of the entity. But we don't have this outside. And it's here that I make the relation with the independent market perspective of the view of the market on this entity. And that it's a crucial thing.
Yes.
And it's a big misunderstood, overlooked. It's the reason why we put it as a title, part of the due diligence that is missing currently on due diligence. So thank you.
Basically, I won't go through all of these because we can provide this to you in other information, but there are specific benefits to the buyer. And of course, the big thing is you want to challenge the financial and valuation modeling. As Laurent said, there's a lot of failure rates. There's a lot of write-offs of goodwill from impairment because they're overpaying for the companies. And in this current environment, that's what's really, really important to understand, because what a company was worth in 2019 could be completely different today. And of course, it can go the other way. There are some businesses that are doing incredibly well because they're benefiting out of this situation. So depending on the type of business you're assessing, if it's one that's at risk from COVID-19, then you really have to look very closely at that. And so it challenges the cash flow. It's the independent market perspective. It provides market assessment and due diligence on all the marketing. It gives you a SWOT, a growth strategy, sales and account management, team performance. As I mentioned earlier, this is so important. And right now in any business that has a high degree of transactions, and if it's located across multiple areas, it might be lots of stores or franchises or dealerships, something like that. The sales process now is so critical to have optimal, because the cost of customer acquisition now is higher than ever. And it's also very, very vulnerable. And so you want to check that, and you also want to check account management, because the other thing is that account management doesn't get enough focus and usually not enough investment from businesses, because account management's role is to keep that relationship strong. And so if companies don't have good investment and good structure in their account management, then it'll usually show up in the customer due diligence that they don't have enough information, they don't get back to them on time, they kind of leave them to their own devices to work it out, etc. So there's a whole bunch of stuff there: wallet share, repeat business, referral, average dollar sales, brand awareness, etc., etc. And the other big one that is completely overlooked in our experience of the companies we've looked at is CRM management, customer relationship management. The amount of times when we have gone to interview the market, and this is across all kinds of projects, not just due diligence, but general feedback as well. The amount of times the data is incorrect, the phone numbers are wrong, we're calling for people that haven't worked in the place for 6 months. And so when we're looking at due diligence, anywhere we see a breakdown in the quality of customer relationship management is an immediate red flag for the quality of account management and sales management. Because if you can't give me accurate information of who to call, then there's no way you can tell me that you've got a really strong relationship with your market, because that should be obvious and it should be 100% accurate. The seller benefits for those that are looking at potentially selling a company, you want to make sure that you get all the information you can. If you build a really good company and you have great loyalty, you genuinely have that really good customer appreciation, which is way above satisfaction, you want to make sure you can demonstrate that you've got all those assets in your business. So you want to make sure you can support the quality of your account management and so on. You can prove that you have high wallet share, that they don't shop around with competitors. You can also prove that you've got high degrees of loyalty and high transaction rates and high average dollar sales and good margins and this sort of thing. If your CRM is really strong, then that's a fantastic message to a potential buyer that this company is right on top of customer relations. It tells you about target market, competitor analysis, and a whole bunch of other things. But this is the big weakness that currently exists in the commercial, financial, and legal due diligence. The financial due diligence, which is what the accountants have got to do, they have an enormous task and a huge amount of work to do to make sure that the financials are secure in the business. They don't have the time or anywhere near the expertise of knowing how to assess team experience and customer experience and how you bring those two together. So next one, please, Laurent.
Thank you. May I just
please jump in? Yes.
mention one really good benefit for the vendor, and as well, most importantly as well for the buyer. It's the integration part. And
yes,
the integration part is a crucial part, and it's where really the assumption and forecast meet the reality, face the reality. And before, in the concept, it's beautiful, everything's gonna go very well. But at the integration part, after the deal is done, it's where there is all those obstacles coming one after another one, and so on. So customer experience due diligence allow you to anticipate all of those obstacles in the integration, anticipate and be more relevant in managing them. And rather than to have them straight away facing them and be on a reactive mode, due to the fact that you made those assessments pre-deal and you measured all the customer experience and how as well your client due diligence going to react. And if you measure straight away after the deal to see how the client base is reacting to this deal, and as well by an independent market perspective, how the vendor team is reacting on the integration, it's crucial. In our research, all the integration could take between 1 to 3 years. But if the integration is not properly done after the first year, the M&A fail. So it's really important to be at the top of the integration, starting pre-deal, and like that you ensure that the 15% rule, as Darrell said last week, to ensure that you got 95% of success. So one thing that I wanted to mention just before to move on to the next slide, and again, another thing that is really crucial to understand, customer experience due diligence allow you to challenge forecast and valuation, but as well, if the score are great and the customer experience is really good, it could confirm the forecast and valuation of the business for a seller. So saying that, all those impacts that we are disclosing come from the customer experience due diligence. Darrell?
Look, the investment, of course, it works with growth strategy, market diligence, and market entry strategy, transaction evaluation, commercial DD, forecasting, achievability assessment. So, no one looks at buying a company if the sales are decreasing and the future looks a bit dark. I mean, obviously, when companies are doing an acquisition, they have brightness of future and have a strategy behind it. So you want to make sure that when they're telling you that this business should have 20% growth or whatever it may be, you have the ability to challenge that by saying, well, that's going to be up to the customers to make that happen. Where's the proof of this? So it also, of course, with the M&A strategy, that's a key part of that. And the value optimization, the pricing studies, the sales force effectiveness, product strategy, in there, the sales force effectiveness is critical, especially now. In any company in this next 1 to 2 years, the sales team are just the golden part of the business, because if they don't keep bringing new business and high quality business, not cheap and discounted, but high quality business, if they're not bringing that in, then of course it's massively risking the financial viability of that business. So that also shows ways to look at product strategy, because sometimes companies are looking to bring other companies together because it has certain products and services that, you know, the core company may not have. So integrating the two together. But the product strategy, that's great to have that as a supply, but you also must understand the performance of the leadership and the team and the customer base, etc., and the CRM and everything else that you have, so you can bring that into the integration of the new company. And corporate strategy, competitive analysis and strategy, economic forecasting and modeling, that is so critical right now to have the ability to engage the market. And when we talk about this, it's the 80-20 rule of the market. So you want to look at which customers, clients, whatever they're referred to as, who make up the 80% of the revenue. They are the ones that you must have the feedback from. So when you're looking at customer due diligence, it's the 80-20 rule that's critical to the business. There's no point talking to the ones that come in once a year. You've got to look at those ones. And then the other thing that what was said to a few people lately is do the assessment of how many of the 80% can you afford to lose before the business is below break even and at risk. Because the assumption that if I buy a company today and I'm going to keep every one of those top 80%, that's an unrealistic expectation. There's always factors in there. And most importantly, it could just be how the economy's squeezing. So this is why understanding how loyal those 80% of the revenue customers are is critical to assessing, you know, the financial forecasting of this business. And then the marketing distribution strategy, of course, that comes out of the questions from the customers around, you know, who else do they buy from? What do they choose from you? What are they aware of in products and services? Quite often we found that the customers aren't fully aware of all the products that the company has on offer. And once you find that, you immediately go back into account management and sales strategy, because, you know, an A-grade customer, those 80-20 rule, they should know every product and service that you offer that's of interest to them. They should never be going to competitors to buy anything. So when you're looking at this, to bring this into financial modeling, forecasting, looking at how you assess the value of the business in the goodwill, what are the multiples you're going to pay? If the vendor, the seller, can't demonstrate to you great CRM and highly educated customers about the products and services they supply, a very documented and defined sales acquisition strategy, a very good account management strategy to keep that relationship strong, if they can't demonstrate any of this with great clarity, then you've got to look at, you know, what are the multiples you're going to pay? Because there are certain situations where we've had clients that have bought a company because they need that brand, or they need those locations, or that customer base to tap into, and that's all part of the game plan. But these things we've talked about so far today, they should always be in the background, because that's part of the asset that you're paying for.
Yeah. Thank you, Darrell. One thing that I would like to reinforce for everyone is the word loyalty. And loyalty right now is crucial. Before, it was really important to know a bit the loyalty. But right now, to be able to measure on the spot in 1 week, 2 weeks, know the behavior of the loyalty of the client base, it's crucial. We've been on
Look, the thing is right now that loyalty is also being challenged by a lot of markets. And so if customer experience isn't at a very high standard, then the loyalty is vulnerable, because a lot of competitors will be doing all kinds of crazy discounting. And of course, the market is a bit cash strapped in some areas. So you've got to look at what are the dynamics around the customer engagement and the behavior that they have through different, you know, times of the year. It could be seasonal adjustments and that sort of thing that happen as well. So there's a lot of things that the customer due diligence can give you a wonderful insight to the business. And the other thing that we suggest to everybody to do is do it first. Straight up, as soon as you can, do customer due diligence first.
Yes.
If it's great and it delivers very high quality results, then it gives you great confidence to move forward a lot faster, potentially. If it shows some red flags, depending on the analytics, You may then jump into team due diligence and culture and looking at leadership and so on, because if there's any weaknesses in those two, then everything else is at risk as far as we're concerned. Unless this is an acquisition that's purely linked to copyright, patents, supply chains, or literally real estate locations or something like that. If the business is being purchased for strategic value and they don't really care about the customers, which are very few deals that happen, then that's not so important. But in the mainstream, getting this information early is critical. And as Laurent explained to me, quite often what happens is 3, 4, 5 months down the track of doing all the financial, legal, and commercial due diligence, and then getting to the customer due diligence, there's a lot of fatigue and people are just wanting to get the deal done. And also sometimes the deal gets done because there isn't any awareness of this. And even if there is, who wants to take responsibility for cancelling a deal 5 months in when this sort of thing should have been known at the start? So quite often the failure rates, what we believe with this is the failure rates are higher because this just gets completely pushed to the side and then it's left up to other people to sort out. But from an investor's point of view and a CEO who's in charge of acquisition, customer due diligence and team due diligence is so critical that if you're aware of it and you don't do it, in our view, it's negligence, because it's negligence on behalf of the investors that you haven't truly assessed early as possible how secure is the revenue from these customers directly linked to loyalty.
Yeah, it's a really good point, and it will definitely, by doing a customer experience due diligence first, it will save you a lot of time and a lot of money, because
yes,
diligence, it takes a lot of time, a lot of money. And straight away you will see if it's worth it or not. Being a strategic thinker and very pragmatic, I much prefer, rather than to have assumptions and subjective assumptions made from judgments, I much prefer to have data, measurement of data, than all those assumptions and a judgment from all kinds of shareholders that could be external, internal of the deal, firms, and so on. All different parties, there is a lot of assumptions, a lot of judgment. When we measure the customer experience, it's a fact, it's an accurate measurement, and it's on the spot. So it's not on the past, it's not in the future, there is no assumption here. It's what does the customer think about the company right now, about the product right now. And for me, to make a good strategy, it's important to have this strategy based on facts rather than assumption.
There's plenty of assumptions out there that aren't very good, and
yes.
Data's everything. Look, just quickly too, we won't go into a whole lot of detail here, but the reporting provides a lot of key findings. So you're knowing this quickly here, you got 65% of the clients surveyed extremely appreciative of their experience. Only a quarter of them scored 8 out of 10 and satisfied. 86% client retention of the retailers gave a 10 out of 10 on returning. An overall average of 32% see their business growing in the next year. So you know that a third of the customers you're acquiring have confidence that they're growing. 71% of the retailers and 79% of the wholesalers that are growing require additional supply, so you can start to predict the growth, et cetera, et cetera. So we're also looking at not just understanding how well the business is serving the market, but we also want to understand how well the market is going itself. So when you're looking at the 80-20 rule and you're looking at all these customers, asking them the right questions can give you a very powerful insight of how they're feeling about the future, because you're buying the future success of their business as a supplier. So it's really critical that you have this information. Anything else you want to add to that, Ron?
Yes, and one thing to Darrell, one thing that you mentioned he could, because we had this event on one of our clients, is that you could discover some hidden gold inside your own service and inside your own business. What do I mean by that? Is definitely when you when your client base doesn't know over 60% of your range of your product, it doesn't mean that you got all this untapped range of product or services that it's a future revenue that you didn't take into consideration. And same for the strategy for a buyer of a business, to knowing that straight away, it's a good thing to be at the top of.
And like in this particular case we're looking at as well, that not all of the wholesalers knew who their account manager was. So we found a weakness in the account management team. And then also the end users, we spoke to a whole lot of them, not just the wholesalers, but the end users as well. And they weren't aware of all the product range. So what was great from the purchaser's perspective is that they were investing in a business that was under leveraged. And so that's the other thing that you want to be able to use customer due diligence for, is to find out not just how well the business is serving the customers, but also what is it that they don't know about the business. And so in this case, it was very rapid strategy to increase the size of the account management team, to put more people into the businesses and to educate them on all the products and services. So there was immediate growth in this particular company that we're talking about, because the previous owner, or the current owner at that time, had been running it for years and years and years, and was wanting to retire out of it, and was looking at cutting costs to keep margins tight, which became a great opportunity for the purchaser. And then here we do things like, executive summary. So you want to know what the revenue growth is, what's the prediction there, and this is where we increase the commercial team. So we could see that by increasing certain parts of the business from customer engagement was going to improve revenue. And of course, improving relationships meant that there was, this business becomes more of the single supplier. So you want to make sure that a company you're looking at, if the market, let's say a key customer spends $100,000 a year on products or services, how much are they spending that 100 grand with you, and how much are they spending with your competitors? And so when the customer experience is really high, you really only lose revenue to competitors when it's due to location, potentially stock sometimes, or there's certain products that you don't have access to. But where they have the choice, they always choose the particular business you're looking at. So these are the kind of things around customer loyalty that are directly proportional to revenue and margin. So next one, Laurent, I think we're getting close. Yeah, we're getting through. We've got a SWOT analysis. I won't read through that. So you want to know the strengths, the opportunities, the weaknesses, and the threats to the business. And the best way to do this is not talk to the company, it's talking to the customers. Yes. And when the customers tell you what the strength is of the business, then you have more truth to that. When the customers give you feedback that the things they don't know about, that they should, that tells you opportunity. When the customers are talking about problems with supply or delivery or product, in one particular case, we found a big exposure to warranty. So people in their feedback were making complaints about they hadn't had their warranty dealt with to their satisfaction. And of course, that wasn't even on the checklist for due diligence. They had not tested, even thought about what's our warranty exposure to this company. And that actually proved to be quite a significant thing. And then of course, the threats are coming from the competitors. How much are they dealing with the competitors? What products are they buying? What's the pricing models and that sort of thing. So you really want to be able to do a one-page SWOT analysis on the customers.
Yes.
Also, we've got things like the brand. In this case, they knew they were the biggest seller, the product quality, the pricing, value for money, recommendations. It's not just the experience. You want to know how they score, the quality of the products, the value of the products. Are they recommending this business as well? Because referral, especially now, referral is the most powerful marketing on the planet, and it's becoming very, very hard to achieve in a COVID environment. So you want to be able to measure what degree of new customer acquisition comes from referral. If that's really low, it means there isn't strong loyalty there because they've got to keep buying customers. But if the referrals are high, that's because it's directly linked to good service, because people will put their reputation on the line for the business and recommend them. So these are factors that currently in the global due diligence process rarely, if ever, are even questioned or understood.
Yeah.
And benefits to the product benefits, most important benefit, other products they're aware of, forecasting the year ahead. This was a really interesting one, which may be different now. And this is a critical one, is, down the bottom left-hand corner, forecasting the year ahead, they're expecting the business to grow, decline, or remain the same. This one had 60% remain the same and 30% grow. And then if growing, would it require additional supply, which was virtually 80%. So it gave a lot of security that nothing much was changing. It was stable, but there was almost a third of the customers growing, and then 80% of them wanted more supply. So when you start to integrate all of these figures and you look at account management scores and different things, it enables, from a strategic point of view, to bring all this data together and really put your own forecast on what you think you can do with this business. And you're not relying upon the current management to give you their opinion. You're getting the expression from the customers, which is far more valuable and accurate.
Definitely.
And then we do things like overall net score from wholesalers. We did retailers, wholesalers. So all depending on what the business does. If it's just purely supply to the end user customer, you have a different strategy. If you're manufacturer to wholesaler, supplier, and then back out to the customer, then you've got more steps involved. You want to know how the market feels about the products. What do they feel about your suppliers and resellers and you? So when you're looking at this, customer due diligence has got quite a lot of angles to it. And the more you have this information, then of course the big one is the confidence of first and the security of the revenue. But the big one with this is how you challenge the price. Because if the scores are low, straight up front in the first 30 days of due diligence, you know what's not good about it. You can immediately start talking price. And if the seller's not interested in negotiation, then you walk away and you go find another one. So this is why doing it early on is very, very critical, because it arms the investor with enormous information.
Definitely. More than ever before, yeah.
Sales rep scores, I think we just keep moving the rock because of time.
Yes.
Retailer scores, how long they've been using the products for, different to others. There's around 20 different data sets on a good customer due diligence project. It's getting right down the rabbit hole and out the other end to find out what's going on. The big one is the due diligence time and cost saving. As Laurent mentioned earlier, mostly it's financial, legal, commercial that starts first, and customers may, if at all, get done at the end. If you flip the whole thing around and you do customer due diligence first, it'll indicate whether you need to do team due diligence, and those two alone could give you enough information to realize we're backing out of this deal, and you could be out of a deal within 30 days and saved a huge amount of money in costs and also massively reducing risk. And the big one is it's a new way to challenge the valuation. And it's not just what I think about your company. There's a third space of saying, well, here's the accuracy from the customers. Your customers that I'm going to buy aren't that loyal to this business. So I'm challenging the whole evaluation and opinion. And it's the whole new measurement that really defines the best strategy, because I'm not buying the past, I'm buying the future. So I want to have confidence that the customers and the team are going to be critical to the success of the future.
All right. It's just to mention on that, it's very critical, because the amount of goodwill that is written off regularly, and it's crazy.
And we've talked about that, Laurent, like in this situation now, wow, this financial year, next financial year, my goodness, there could be just enormous amounts of money written off.
Yes, correct, yeah. This 30 June, we can already expect a lot of written off goodwill. I've I saw plenty of cases, and sometimes lately one company that just acquired 3 businesses, after 6 months they wrote off over $180 million of goodwill, AS6 listed company. So just after 6 months, imagine now how it could be so quick. So, and the last point, it's definitely customer experience due diligence assist you to get a better definement of your best strategy for the deal. Yes. So we're going to jump to the Q&A because we are on
Yes.
on time. I stop sharing the screen, and I invite everyone to share questions. And if you don't have any questions, I think we got the pleasure to have David back with us, and he can ask us the first question.
All right. Thank you very much for your talk so far. Very well researched and great information. So one question, how will working from home impact the valuations of a company?
So is that, David, how was working from home?
Yeah, how working from home with all the customers, or
right, yeah.
or as a customer, like the customers are working from home, or your staff is working from home, the ability to maintain the value of your company.
Yes, look, something that hasn't had to be measured before, which now is a very common thing that's happening across most companies, especially large ones. And what we're seeing in our normal customer research in our business is that there's a bit of a breakdown in the customer experience, because I'm not calling the office, I'm not walking into the store, and people are working from home, and then you've had people with their kids at home from school, and there's no question that while the working from home has had a lot of benefits for the team and the company internally, but what isn't being spoken about is the impact it's having on customer experience. And in actual fact, a lot of the working from home is breaking down the relationships, because it's just not the same anymore. And the other thing is, of course, that it's not just the business that you're looking to acquire, how well are they operating working from home. If they've got 100 customers, then there's 100 businesses that have also got their teams working from home. And it's really important that you're able to understand the impact that's having on customer experience, because it's having a big one. And a lot of people are completely unaware of this because they're so internally focused on being able to keep the doors open, which I totally understand. However, we must be aware of the impact that this is having on our team, because our team are the conduit to the customers. And if the team is stressed, then the customers are stressed. So this is a whole new thing, David, that I would be very surprised if there is a single due diligence going on right now that has got work from home as a part of the component in how it's impacting customers. They might be looking at it from how it's saving them money and they can rent less office space. That's great for the internal stuff. But are they measuring the impact on the market? Very good question.
Yeah, very good question. David?
I'm seeing the impact at the public service level, where they're all working from home, having to deal with various government departments, and things are put on hold. We'll extend this. Clients are asking for answers. Oh, the person, like the other week, the tax officer said, I'll finish this by Friday. Well, Tuesday, I ring, what happened? Why isn't it finished? The bank's screaming at us because we haven't got a job yet. Oh, I had Friday and Monday off sick. But she was already at home.
Yes. That gives you the full picture of the whole what's happening.
You have to ring people just to follow up. And that's at the public service level. I don't, but my clients that are busy are keeping the wheels moving, and it keeps going through.
So thank you, Judy, for your you mentioned. Thank you very much, Judy, Darrell, and I, and Laurent. Great presentation. When you're looking to raise capital, how should founders evaluate their company? And especially if it's a startup and doesn't have a numbers on the board. What do you believe drives customer loyalty? With social media, people are not as loyal to brands as they used to be. How can brands increase brand loyalty? So there is a few questions here.
Yeah, look, it's a tricky one because quite often with startups, it's all about the future. Whereas a lot of mature businesses, the real foundation of the valuation and the asset is the past and the things that have been created. So with startups, I think it's very important for startup businesses and anyone who's looking at a startup business, even if they've only got 20 or 30 customers, you've got to speak to as many of them as possible, all of them if you possibly can. Because the thing with this is that anyone who's got a startup business, they're already a little bit biased about its potential because it's their idea and they're passionate about it, and they can have quite an unrealistic assessment sometimes. I mean, you just look at the success rate from venture capital and startups, it's pretty low. So the one thing with this is that anyone who's got a startup and they want to get more investment, while it's great to have business plans and strategies and market assessments and so on, find a way to get customer engagement into that. Because if I know that the little things you're doing and the startup that you're doing and the journey you're on is already having a very powerful positive impact on your customers, then I've got confidence that you know what you're doing. And often this is completely left out of the equation. And we've had people that have asked us about, well, you know, how do I assess this company? I've got all the strategy and the IT and the business plan and so on, but I haven't got any feedback of how well it's working. Then you're throwing darts and guessing. So always find a way, because a startup has an intention of getting lots of companies. That's why they want a lot of money for it, a lot of customers. So therefore, however many they've got, interview them. Focus groups is another great way to do it. But if anyone is looking to invest in a startup, you really want to make sure that the market loves this idea and has demand for it, because great ideas happen every day and people go broke on them.
Yes. Yesterday's presentation by Caitlin,
Yes,
she spoke about someone wants to work out what business to do, and her advice was go and talk to as many people as you can about their problems.
Yes.
And if you do a presentation about why your product is going to solve the problem, here I've surveyed 30 people, keep telling me this is a common problem throughout the whole situation.
Yeah.
There's already the starting point.
Yeah. So
which is along the lines of what you're saying. It crosses over and just cements.
So just to mention, thank you, David. Thank you, Darrell. What I really recommend, because I've been there, done that as well on my entrepreneur hat journey, is to be as close as you can be to the customer and ask your potential client, even if it's not your current client, your future client, what do they think about the product? What do they think about the service? And like that, you will be able to make a product or service and to sell it the best way. Because more you know about what your customer or your potential customer think about the product and service, better and more success you have a chance to try. So
yeah, and look, the other thing just quickly on that too, for Judy's question, so a really good question, is that so many businesses in this situation are moving to online, and therefore, as she says, you know, the brands aren't as loyal as they used to be when you go into a hardtop store, for example. So that being the case, and the competition just popping up in your phone, Facebook, whatever it is all the time, one of the things that is often left out here of the technology space is still customer experience. And so while you may have a contactless engagement, one thing that is very effective and very powerful and very easy to do, is don't send people emails or text messages.
That's it. Correct.
Pick up the phone and talk to them.
Yes.
You buy a product online, you'll get you want to make sure it's been delivered and that sort of thing. That's all good. The text messaging and the email is very, very good in the online world, but it's incredibly powerful if that company calls you up a few days later just to check in and say, hey, thank you so much for your purchase the other day. And by the way, just want to check in, is fulfilling your expectations. How do we go? You're happy with everything. That just sends a message of confidence. There's actually people behind this business and they care. So there is a great way to have a point of difference in that social media online market, and that is that most are just using technology for communication. Put human to human in there as well, and you'll be amazed at the impact.
Yeah, and people love to be heard. And just to give you an idea, compared to on the conversion rate, rather than free, if you email or do a survey, you got free to maximum 5 or maybe 10%. Us, we got 74% of conversion rate. So it's a big difference. So we'll have to move on to the next question from Danny, because I'm just conscious about the time. We're already over time, but let's
make it quick. I'm reading
Thank you from Danny. Thank you for your presentation. It was great. I do have a question, which is, would you recommend that a new startup business that has an intention to sell within 2 to 5 years to actually set up a customer survey system from the beginning? As would this provide an opportunity to actually increase the business sales price?
Absolutely. And not just the business sale price, because what happens here, and this is what we do every day in our normal process of measuring customer experience. From a startup, you've got a whole lot of ideas and you're going to make mistakes. And the one thing that we always say is, if you're going to make mistakes, make them as fast as you possibly can. Fail as fast as you can.
Yes.
So all the way through the journey of starting up and getting going, constantly ask and get feedback from your customers. And what I mean constantly, don't send them an email every day, but make sure that you talk to them, that you go and see them on site, if that's the case, or you pick up the phone, whatever it may be. But always using customer feedback as the only voice that is confirming whether you're doing a good job or not. Never ask your team, are we doing a good job? Because they'll all believe they are or should be. And that's important. But at the end of the day, it's the person with the wallet that pays the bill that keeps everyone in a job. Their opinion is the only one we're interested in, because it's independent, it's unbiased, and it's coming from the truth. Because if I've just paid you $500 and you've done an average job, I'm not going to tell you you've done a good job. And if you've done a great job, I'm not going to tell you you've done an average job. I mean, we find that people just tell the truth because it's about their experience, and most people are very, very honest when you ask them. So in that case, as you're building it through, you imagine when you get to the time of selling the business, and you can look back year upon year of customer journey information. Wow, is that going to be an asset to the purchaser to have confidence in investing in the business? For sure. Definitely do it.
And go for it. As you know, the systems are very important, and due to the fact that you're doing a startup, it is the best way to build your system right from the start. So I totally agree. I couldn't say less than Darrell. Well said, Darrell. Go for it, Danny.
Okay, thanks, guys. It's a fabulous presentation. The comments have been great about what you've said today, and it's all valuable information, and been building on, Darrell, your presentation last week and all the content that we've given this week. And I want to thank both of you for today's presentation. And I just want to read here, I just saw your tagline, Darrell, on your business. Now I've got a quote. It's because I love quotes. Different isn't always better, but better is always different. I think it's a great line.
It is a great line indeed.
And I'll quote you, or I'll dine out on it. And I thank you guys very much for today's session.
Thank you. Thank you. Darrell, would you like to say a few words?
Thank you. Live long and prosper.
Thank you. Thank you so
And
much.
don't forget his book.
Yes, that's it.
Yes.
For next time.
Right?
That's it. Thank you so much, everyone, for joining us today, and hope to see you next week for the last two webinars of the New Economy Summit with two extraordinary persons, the futurist Maurice and the extraordinary Michel, to talk about the Sustainable Development Goals. So we wish you all a wonderful weekend and hope to see you next week. Bye-bye.
Bye.